or very commonly what we see in China is a lot of CapEx and a lot of acquisitions. And so if we see that, then we really ask ourselves, okay, well, what sort of research would we have to do to confirm whether they're buying legitimate assets or whether there's a good reason for the accounts receivable to blow out versus are they using this to commit fraud? And so then a lot of it for us becomes a question of how, what kind of resources are needed to do this work. And we have to look at it on the other side. Okay, how big of a short position are we likely to take? How much of a fraud do we think this is? Because, to be quite frank, in the world of China stocks, and if you're going to say a company is increasing its revenue fraudulently by 10%, the market doesn't usually care about 10%. If this were outside of China, 10% would be a big deal. But so we have to really think about how profound is the thesis versus the resources that are needed to produce a report.
Interesting. You know the culture of the market very well as well. How many people do you dedicate to each case in Hong Kong?
Well, so we have our internal team. So the core research team at my firm, including myself, is 5 people. And then when whenever we're researching something, we use consultants and investigators and other researchers. So it's, there's never a fixed team size, so it really varies.
So you work on multiple cases at the same time?
Yeah, we do. We're working on 2 or 3 at the same time. In this business, it's actually kind of hard to work on 2 equally well at the same time. So we tend to focus on one, but we'll try to move along 1 or 2 others in the background.
And your very first case, that is about Oriental paper, right? So that case, you flew to Hebei with a friend on your own to do the field studies and to talk to the CEO and such things. Do you still do that by yourself now?
The answer is no, but I wish. I mean, the field work, I used to really enjoy doing that field work. I think the last time I did field work was on China Media Express when I went and met with some of the bus operators and I toured buses and confirmed that CCME's equipment was not on these buses. Also with Sino-Forest, I actually went to a meeting with one of their internal investor relations person. And I also, with Olam, I kind of sneaked into a meeting with management as well. But Olam was the last time I did it. The risk of being recognized is just not worth the reward. And I used to like looking at management when we'd ask a tough question and seeing how they respond and just seeing which questions made them most uncomfortable. But it's just not worth the risk of exposure at this point.
When I saw your stories, I see you can make a very, very good investigative journalist because all the work you have done. So now you might have trained your employees to do the work for you?
Yeah, most of the people on the research team, 3 of the other 4 people have been with me for a number of years. So they're very good at what we do. But one of the things that's important to understand about how we work is that each person has his or her own specialty. So we have an accounting analyst. We have somebody whose background is in manufacturing and sourcing. So he really understands the businesses from the operations perspective. My specialty is, it's kind of combining specialties really, legal, real-world entrepreneurship, and finance investing. So I sit atop the team and synthesize their work into my own view and our research.
I think if you go to China now, a lot of people may recognize you, and you are a loud short seller. So why to be a loud short seller? How does that benefit your strategy?
Well, it turns out that shorting without speaking about your shorts these days, post-financial crisis, is a very, very difficult strategy. You've got this situation where globally central banks have just been creating money, and that's gone into the asset markets, and it just keeps pushing up equities. So even though there are companies that short sellers can find that where the stocks shouldn't be going up, and these companies shouldn't be getting acquired, the stocks do go up, and the companies are getting acquired. And it's been a very, very difficult time for funds that run the passive short strategy. So I'm not saying it doesn't work, but I think the best way to think about the funds that run these passive short strategies is that they are insurance for their clients. So when their clients put money with one of those funds, client isn't thinking, oh, I hope I get 15% a year from this. They're thinking that over the long run, this is going to smooth out the volatility of my portfolio, and because when the market goes down, this will at least make me money. So most short funds that are still in business, I think their function is really more of an insurance business as opposed to generating returns across, even during bull markets.
The regulators in Hong Kong cracked down, like Moody's, Citron. What do you think of that?
Well, I think each case had facts that were particular to it. So I don't know that. What I took away from that was, we always are very, very careful. There's always more that we know than we actually say, because maybe we don't have 3 sources of evidence for it, only 2. So we won't say that. So when we look at what's happened with Citron and Moody's in Hong Kong, it's just a reminder that we have to be very, very diligent in what we put in our reports and what we say publicly.
Is it because, like in Hong Kong, there is more individual investors than institutional ones? So maybe the shareholders need more protection, so they want to protect the individual investors more. So that's why they tighten their regulations.
Well, that's an interesting question as to why. I don't really. You can look at Hong Kong and say there's some things that Hong Kong does that are protective of shareholders. And you can also look at it and say, well, there's some other things where there are markets outside of Hong Kong that are more protective of individual shareholders. So I really don't know the policy reasons behind what they did. I just know that's the playing field in Hong Kong, and you have to respect that.
We are now at NASDAQ. Like 2 decades ago, a lot of Chinese companies took pride in ring the bell here. And a lot of US investors, they chase after every Chinese concept, and that all changed. A lot of people say that you play a very important role in the change. What do you think?
Well, yeah, I think that's somewhat accurate. But what also has to be considered is that a lot of the companies that listed here a lot of them were frauds. So what we did was, it wasn't to make people say, oh, I hate everything that comes out of China, but it was to say a lot of these companies have problems. There have clearly been gaps in the system that's supposed to regulate these companies and protect investors. And so I think what we did was we caused a lot more scrutiny to be placed on these companies. And the change was profound, because my impression, say from 2010 before that, is that in China, US investors were kind of a joke, because we were considered to be so gullible, and we just we just believed everything. These companies would come to the US and say, oh, well, Chairman Wang has this thing called guanxi, which means connections. And American investors would just say, oh, guanxi, that explains why he can grow his business much faster than everybody else in the history of this industry has. And so what we did was, I think we opened up investors' eyes so that they looked at those, when they heard statements like those, they just said, you know what, I don't think this is true. And so I think that was the big change that we helped drive.
But nowadays, do you think the US investors are too sophisticated in Chinese companies, because I do came across investors in the US, they will not touch upon any Chinese companies. Like before Alibaba's IPO, people say, oh, I know this is a good company, but I will not buy it.
Well, I think that some of the things that also complicate it for U.S. investors, so there are a couple of things that I think are issues that have remained unaddressed. One is the structure, the legal structure that a lot of these companies have when they list in the U.S. They are what we call VIEs, or variable interest entities, which means that as the shareholder of the list company, you actually don't own the main operating business. And I think that's a very dangerous situation. Now, to be fair, that a number of these VIEs, they have gone private, and even though in reality the chairman and whoever brings them private could have just taken the operating business out from underneath the public shareholders, to be fair, almost all of the time the public shareholders have gotten paid. There have been a couple of instances where VIEs have just been robbed of their assets, but those were generally smaller reverse merger companies. But I think the VIE structure, I do think that's an issue. I have ideas on how to address it, but I don't think the investment banking industry here would find those appealing. The second issue really does come down to how much politics and business are mixed in China. It's very, very, even for Chinese business people, it's difficult to understand and predict the environment. But there have been, of course, high-profile cases of public companies whose chairmen have, whether in Hong Kong or the U.S., have disappeared and supposedly been, they've been detained. And I know that's something that scares a lot of U.S. investors, because you're thinking, how do I understand this risk? How do I price this risk, or the risk that another company will become politically favored and will crush the company I'm invested in? So from a foreign investor standpoint, the political risks, the political business risks of China, or investing in China, are just, they're very high.
And one thing is that you captured a problem in a company, like the political risk. The other thing is that you have to translate that to your U.S. investors to make them believe in you as well. So that is two things, right?
Well, we don't look at political risk when we're, that's not really what our short theses are based on. We've seen situations in which, I'd say, if you look at a company that we shorted in 2013, NQ Mobile, Wang Qin.
Yeah.
So that was one where it's a company that clearly did not have political protection, because CCTV had done an expose on it, accusing the company of cheating its customers. So that's one that we felt more confident shorting, because one thing is, in our position, we're sometimes worried that there'd be people who would really look to protect the company and help cover up the truth. And if the truth gets covered up, the stock might not go down and we might not make money. So that's something that we give a little bit of consideration to. But in general, when we communicate our theses really are, hey, this company is a fraud. We think at least this much revenue is fake. This undisclosed related party that is the main supplier or customer is not a real business. Here's the evidence. That's really our core way of putting together a China short.
Your father used to be a long investor. If he came up to you and said, I want to buy Alibaba, what kind of advice would you give him?
I would say, that Alibaba is a bit of a tough one for me. Look, there's a lot there that's genuinely impressive. Okay, I had a real world business in China before I started Muddy Waters, and I can tell you how difficult it is to scale a business anywhere, but especially China. And so Ma Yun has done an amazing job building that company. That's on one hand. On the other hand, you have political risks, and I know sometimes, people in the U.S. will say, yeah, I'm a little worried about Baba, it's so big and powerful. I wonder, if that's sensitive in China. I don't know. It very well could become sensitive. I don't know how to handicap that risk. And then on the other hand, yeah, there's an element of Baba that's too good to be true. And so if my father asked me for my advice, I guess I would just say, look, talk to somebody else. I don't have an opinion.
Is there any Chinese companies right now listed here in the U.S. Raise your eyebrows? You think you want to do a research on them?
There are companies, when we look in their filings, we'll see yellow flags or red flags, and that we'll think to ourselves, these companies are probably frauds. But the issue for us is that the bar. Okay, so if you're sitting around watching us talk about a given company that we've started researching, the bar for us to say this is a problematic company, let's say that bar is here. We're all skeptical people in my firm. We've been doing this for years, but the bar to convince the long shareholders to sell is much higher bar.
Yeah.
So the question that we have to ask is whether we think that within our resource budget, we can meet that bar. That's a different question. So yeah, we'll see these companies that are suspicious, but a lot of them we just say, I don't know how we would prove it to the satisfaction of the shareholders.
Recently, you published an article on U.S. market is more likely to default. So can you maybe elaborate more on that idea?
Sure. So I'm sure most of your viewers are aware that right now the politics in the U.S. are not exactly smooth.
The Trump rally.
Yeah. Well, yeah. We had the Trump rally, but the thing is, what nobody's talking about in the U.S. is that we have hit what we call the debt ceiling, and so the U.S. government is not able to issue net new debt above this level. And so Treasury only has so much cash on hand. And that money, without our ability to borrow, which we already passed the debt ceiling middle of March, without the ability to borrow new money, so in order to borrow more, Congress has to raise the debt ceiling. And in the past 5 years, we've had that situation twice. And it's gone down to the wire. It's been very close in the past to where the Treasury ran out of money and was not able to make interest and principal payments on the debt. Fortunately, in the past, enough people from both parties came together and they raised the debt ceiling. But what's interesting here is that a lot of people assume that because the one party now controls the White House and each of the two houses of Congress, a lot of people assume that it won't be a problem to raise the debt ceiling.
Sure.
But I think it will be a problem because within the Republican Party, you have these factions that are very divided. And there's a faction in the Republican Party called the Tea Party. And the Tea Party, these are people who were the ones who greatly resisted raising the debt ceiling in the past. I mean, their view is that they want to starve the federal government of revenue in order to force it to get smaller.
Yeah.
And so they really could end up, so my base case scenario is that the U.S. will not default. I think enough cooler heads will prevail and will avoid a default. But I think we get closer to a default than we have in the past, and a default is a real risk because if the Tea Party people cannot, if enough of them don't change their minds about not raising the debt ceiling, I don't think the Democrats are going to help the rest of the Republicans raise the debt ceiling. I think the Democrats would rather watch the Republicans commit political suicide than help them out.
And a lot of people think that we are now in a very dangerous late bull market. A lot of stocks are boosted by unnaturally cheap money. So does that mean an easier environment for you to have a short idea?
Yeah, I mean, so probably the number of bad companies that are out there is the same as it's always been, but the difference is you've got more bad companies with real market caps now than you used to have. So from a short seller's perspective, that's a positive. But on the other hand, with the market just constantly going up, it's actually pretty frustrating. And people seem to have forgotten about volatility. And the thing that amazes me the most is when you look at the implied volatility of the market, it's so low despite all of these massive geopolitical tremors, if not earthquakes, that we're having. So, and from a short seller's perspective, I guess if you don't think, I mean, volatility has to pick up in order for some of these short theses to play out. Because otherwise, if everybody is really complacent and the market just keeps doing this, a lot of the stocks that should fall won't fall.
The return is pretty good, like 16%. So is this much more or less than Muddy Water Research?
So for legal reasons, I can't comment on performance. You might have been referring to the flagship funds that we launched on August 1st of last year. And so that had less than half a year of performance. But we were very happy with the performance of that and our day one fund as well. So yeah, in terms of, is it similar to the returns that we produced before? Yeah, somewhat. I mean, obviously in the first 1 to 2 years of my business, we used more options because we had less money, and you could make 200% a year. So can't compare, can't compare to those periods. But generally, I like to put up about, this was pre-managing money on my own money. I would try to put up about 30% a year. That would be a decent year.
And you took like $100 million money from outside, and you say you will never take more than $500 million. Why is that?
Well, for what we do as short activists, it's very limited capacity, and even 500 is, I think, too high for what we do. So I don't know what the limit is. The other thing that we can do, if we come across a trade that's particularly that has a lot of capacity, we can always take in more money for purposes of that trade. But I think day in and day out, probably don't want to be too far above $200 million. That's my feeling at this point.
I look at the research saying that assets under hedge fund that is targeted on short companies is only like $5.5 billion. That's relatively very small. So is the circle very small? Do you all know each other and talk?
I think a lot of us know each other. It is a very small and shrinking universe of short sellers. I mean, talking, occasionally. I mean, I sit in San Francisco, so most funds are here in New York. London has a lot. I don't speak or socialize that much with fund managers and analysts who are based in London and New York. So, but yeah, just like anything else, I mean, people within the industry, they talk to each other. I mean, at varying amounts.
What do you enjoy right now? For example, in the past, you said that you enjoy investigate into a company, you enjoy the field work, and now you don't do that. And here, the hedge fund society is here in New York and London, but you are not here. So, what's the most enjoyable time in your life like?
Heavy is the head that wears the crown. I now have a bigger business, and I do a lot of what I call principling. It's not a real word, but it's my version of saying that I have to act as principal. So running a business that is now bigger, especially regulated business, there's a lot of time I spend on legal. There's a lot of time I spend on just talking to vendors or potential strategic partners, marketing. So there's a lot that I do these days that's not directly involved in the research. And the problem, I really like doing the research, and I also like a lot of what I do as a principal as well. It's just the biggest problem I have is that it's two different speeds of thinking. Your brain runs at two different speeds. So if I'm marketing, or I'm talking to a potential client, or if I'm doing an interview with you, my brain is running at somewhat of a faster speed. But to do research, really close the door and just read through a bunch of filings from earliest to latest, that requires a lot of uninterrupted time where your brain can move very slowly and you pay attention to details. And I get sometimes a couple hundred emails a day. I mean, it's it's very difficult to do these things now. So it's like any other business that's evolved. I become a little bit less in the operations and more of a manager.
Thank you so much, Carson.
Thank you.
Thank you. So is this like a pre-war period in your office? Because we know that you have several Hong Kong reports at hand. Is it like pre-war period for your office?
Well, I mean, I wouldn't say that we're really, really buckled down getting ready to go to war. I mean, we're not looking just at Hong Kong listed companies. We look at companies in Europe, we look at companies in the US. A lot of these end up being nasty confrontations. It's pretty predictable what happens. We come out on a company and explain our thesis and why we're short. Company will, I could almost write the response in my sleep, where they say that, such and such, Muddy Waters Capital are short sellers, they stand to profit if the stock goes down. The report contains misleading statements, exaggerations, and falsehoods. We are considering taking legal action. So they automatically, these campaigns, they get pretty nasty regardless of where in the world they are. And I've been doing it 7 years. People who are with me, most of us have been at it together for a number of years. So it's not like it was in the beginning where there was a huge knot in your stomach and you're really getting ready as though you're going into combat. It's we're more calm about it than in the early days.
As you said that you have a lot of blowback from the companies you targeted at. So because they are very, some people say that the time is on the bull side. So if there's enough time and the investor is not sure about targets, they usually bet on the probabilities. So if the time is long, maybe the short seller will lose. What do you think?
Well, so look, when we've analyzed our long-term track record, the vast majority of cases, the stock goes down over the long term versus staying flat or going up. We are probably over the long term, 65 to 70% go down. Now, and that's as good a ratio as anybody in investing has, especially when you consider that we're doing it on the short side, where again the markets are built to go up. But if we say it's 65% are wins and 35% are not wins, one thing is true, at the outset, I have no idea which is more likely to be 65% name or a 35% name. I wish I knew, and if I knew, then of course we wouldn't do the 35% names. But yeah, it's what we try to do as activist short sellers. We just try to knock over a bunch of dominoes and create enough pressure on the company that the dominoes keep falling and we get a win over the long term.
For those Hong Kong stocks, the Hong Kong market volume is not that great, and sometimes there is a manipulation maybe behind the company. So what's your strategy under these circumstances?
Yeah, if we think something's manipulated, that's a little bit of a tough one in terms of coming up with a strategy. We really have to think about whether it makes sense. And we could pull up charts of a bunch of companies in Hong Kong where the stocks have done this, and we're certain that pretty certain those are manipulations. With Huishan, we didn't get it as right as we wanted in terms of, since we viewed it as a manipulated stock, or we felt it was highly likely that Huishan was manipulated. We were really hoping that we could break that manipulation a lot sooner, but it held out for about 3 months. So we don't have a strategy per se. We just try to be selective, understand where the sources of capital for the manipulation are likely coming, how much selling. So one thing that's important when we look at potentially manipulated stock is if there are not a lot of real shareholders, by this I would mean active shareholders, who could read our report and then change their mind about owning the stock and sell, then it's very difficult to see how you break a manipulation. You need what we call natural sellers in order to do that. So that's really the heart of our analysis when we look at those companies.
So for those Hong Kong companies, you do investigation into whether they have relationship with like potential buyout firms or large investors?
Well, if it's an obvious manipulation and fraud, that's not so important. But we want to understand who owns the stock, like who really